Module 4 of this course relates to the changes of equity statement. Please pay particular attention to this module, as most students seems to struggle a lot when it comes to understanding the preparation thereof. I will go through it slowly, and try to explain as much as possible. The compilation of changes in equity is governed by accounting standards and regulations similar to those that govern the preparation of financial statements as a whole. Here are some of the key principles and regulations that typically apply to the compilation of changes in equity. Let's start by looking at the International Financial Reporting Standards. These standards provides guidelines for the presentation of changes in equity under IFRS. It requires companies to present a statement of changes in equity, showing all changes in equity during the reporting period. Next, we have the Generally Accepted Accounting Principles or GAAP. In the United States, GAAP provides guidance on the preparation of changes in equity statements. Principles may vary slightly from IFRS, but the overall objective is similar. Next, we look at the components of changes in equity. Changes in equity typically include items such as net income, dividends, share issuances or repurchases, changes in accounting policies, and revaluations of assets. Moving on, we have the disclosure requirements. Both IFRS and GAAP require companies to disclose significant information related to changes in equity. This may include explanations of the reasons for changes in specific equity accounts, such as retained earnings or additional paid-in capital. Consistency and comparability. Like other financial statements, changes in equity should be prepared consistently from period to ensure comparability. Changes in accounting policies or corrections of errors should be disclosed and explained. Materiality. Materiality is an important consideration in the presentation of changes in equity. Significant changes should be clearly disclosed, while immaterial items may be aggregated or omitted. Internal controls and audit requirements. Companies are expected to have adequate internal controls over financial reporting to ensure the accuracy and reliability of changes in equity statements. External audits may be required to verify the accuracy of financial statements, including changes in equity. Legal and regulatory compliance. Companies must comply with relevant laws and regulations governing financial reporting in their jurisdiction. This may include specific requirements related to the presentation of changes in equity in annual reports or other filings. Shareholder rights and corporate governance. Shareholders have rights to understand changes in equity, especially regarding dividends, share issuances, and other transactions that affect their ownership interests. Corporate governance principles often emphasize transparency and accountability in financial reporting. Tax considerations. Changes in equity may have tax implications for both the company and its shareholders. Tax laws and regulations may impact the timing and treatment of items such as dividends or share issuances. Adhering to these principles and regulations ensures that the statement of changes in equity provides stakeholders with a clear understanding of the factors contributing to changes in the company's equity position over time. Equity represents the net assets of a business. It represents the net funds invested into the business by its owners. The owners of a business own, or have a claim on all of its net assets. And we call this equity. That is basically what owner's equity in a nutshell is. Let's look at the definitions of equity. Equity is the residual value of an entity's assets, after deducting all its liabilities. Equity represents the net funds invested into a business by its owners. So, owner's equity represents the residual interest in the assets of a business after all debts and obligations, liabilities have been settled. It shows the portion of the company's assets that belongs to the owner or shareholders. In simple terms, it is what the owner truly owns in the business and can be calculated as assets minus liabilities. Owner's equity can increase through profits earned and owner investments, and it can decrease through losses and withdrawals, drawings, by the owner. Remember this equation. Assets is equal to owner's equity plus liabilities. On the broadest scale, there are two ways that funds can be invested into a business. Firstly, to finance its operations. It could choose to borrow money from third-party lenders like banks, which in essence are liabilities. Or secondly, it could choose to use the net funds invested into the business by its owners. In other words, it could choose equity. Equity represents the net assets of a business. It represents the net funds invested into the business by its owners. The owners of a business own or have a claim on all of its net assets. And we call this equity. Let's dive in a little deeper. Owner's equity is the portion of a company's assets that an owner can claim. It's what's left after subtracting a company's liabilities from its assets. Owner's equity is listed on a company's balance sheet. Owner's equity grows when an owner increases their investment, or the company increases its profits. That's a good one to remember. Owner's equity grows when an owner increases their investment, or the company increases its profits. The equity statement indicates if a business owner needs to invest more capital to cover shortfalls, or if they can draw more profits. Some business owners utilize this data when making business decisions, such as expansion and diversification. This is one of the most important and underrated lines in your financial statements. Owner's equity. Now, moving on, we calculate this by subtracting the liabilities from the assets. Owner's equity is what would be left over if you liquidated your business and paid off any debts. Here's everything you need to know about owner's equity for the business. Owner's equity is what is left over when you subtract your business's liabilities from its assets. The term is typically used for sole proprietorships. For APTY, the term used is shareholders or stockholders' equity. Now remember, it can be negative if the business's liabilities are greater than its assets. A point to take note of is owner's equity is not always a reflection of the value or sales price of the business. Owner's equity includes money invested by the owner of the business, plus profits of the business since its inception, minus money taken out of the business by the owner, minus money owed to others. Easy peasy. If the business is structured as a corporation, equity may also include accounts like retained earnings and common stock. It can also include preferred stock, treasury stock, and additional paid-in capital. The one question on everyone's mind is owner's equity an asset? Now, business owners may think of owner's equity as an asset, but it's not shown as an asset on the balance sheet of the company. Why? Because technically owner's equity is an asset of the business owner, not the business itself. Business assets are items of value owned by the company. Owner's equity is more like a liability to the business. It represents the owner's claims to what would be left over if the business sold all of its assets and paid off its debts. Another question is, can owner's equity be negative? Owner's equity can be negative if the business's liabilities are greater than its assets. In this case, the owner may need to invest additional money to cover the shortfall. So, when a company has negative owner's equity, and the owner takes or draws from the company, they should monitor their capital accounts and try not to take money from the company unless their capital account has a positive balance. That was quite a lot of information. Stop the lesson here and take notes of what we have discussed thus far. As explained earlier, the equity section can include various line items. See the illustration. Let's explore some of these items. A more detailed explanation of some of the line items that appear on the statement of changes in equity. Let's begin with the opening balance. This represents the balance of shareholders' equity reserves at the start of the comparative reporting period, as reflected in the prior period statement of financial position. These are factors that can trigger a change in equity. We have changes in accounting policies. When accounting policies change, adjustments are made to stockholders' reserves at the beginning of the comparative period. These changes are reflected in the statement of changes in equity. Next we have net income. The net profit or loss reported in the income statement during the period contributes to changes in equity. It's essential to consider this impact. We also have dividends. Dividends declared and paid to shareholders reduce equity. These are typically reflected as a negative adjustment. There are other changes that includes various adjustments not captured in the income statement or balance sheet. Examples include equity withdrawals, accounting policy changes, and corrections of prior period errors. Remember, the statement of changes in equity helps shareholders, investors, and analysts understand the factors that led to changes in equity capital. It provides valuable insights for informed decision-making and financial reporting. Now, On the next page you will find a basic layout of an equity statement that is very easy to follow. Remember, we are seeing comparative periods, that is 2 years of information. The figures on the right is your closing balances of the last financial year. We simply subtract the closing balances on the right, with the closing balances on the left, which is this year's closing balances, to get the net movement. The illustration at the bottom is the adding of the net movements to compile the statement in changes in equity. This is as basic as it gets. To complete complex statements of equity, we have to understand the basic layout. Take a moment to look at the illustration, it's easy to understand.